everybody. So I'm here this afternoon to tell you the story about the evolution of an industry that has great importance to the Canadian economy. That is, obviously, stock exchanges. Media coverage on this topic is often surrounded by a lot of politics and emotion, but the story that I want to tell you about today is actually one about technology. Specifically, how it disrupted the stock exchange industry and drove extensive consolidation that trumped politics. At a time when FinTech is dominating headlines across the financial services industry, the impact of technology on stock exchange history contains important lessons. So, what are stock exchanges and why are they important? Exchanges are a critical piece of financial market infrastructure. They facilitate the efficient deployment of capital by listing securities of corporate issuers. They bring together buyers and sellers of those securities and provide a transparent record of prices at which those securities trade. This activity has been occurring for centuries, and in many ways the business model hasn't changed all that much. The exchange game is one of the earliest and purest expressions of network effects. Success is all about attracting stakeholders to transact in a single place, because the more buyers and sellers transacting there, the more other buyers and sellers will be drawn to transact there as well. This dynamic is so important the industry has an expression for it. Liquidity begets liquidity. It's kind of like having a really hot party. If everyone who's anyone is going to be there, you want to be there too. Because liquidity begets liquidity, exchanges have often been described as natural monopolies. All other things being equal, the most efficient way to connect buyers and sellers is through one single large exchange. Originally, exchanges brought buyers and sellers together by providing a physical location, first at a specified place on the sidewalk, and later in a dedicated building. The placement of that location was important because it drew people from far and wide to transact. As trading activity increased, the brokers who represented buyers and sellers formalized the process. They implemented rules to facilitate trade, share the cost of doing business, and restrict access to people who paid to play by purchasing a seat. Thus it was that brokerage firms came to be the owners of exchanges. This legacy of member ownership persisted around the world until the early 2000s and played a key role in shaping the development of the exchange industry and its business model. Because these firms created exchanges for the sole purpose of enabling their own businesses, exchanges were run as cost recovery enterprises. Costs were recovered primarily through two different types of fees. Issuers paid fees to list their shares on the exchange, and buyers and sellers paid fees for each transaction they did on the exchange. Because brokers controlled the exchange, there was a strong bias toward keeping transaction costs low, and any changes or investments had to be agreed by all the seat holders. This governance model worked well enough when most activity was done manually and the bulk of expenses related simply to processing transactions. However, when computers and communication technologies were introduced, things became much more complicated. So, technology impacted the exchange business in 5 ways. It reduced geographic boundaries. It increased the fixed costs of running an exchange. It increased the volume and speed of trading, reduced transaction fees, and introduced an entirely new revenue stream, data. In short, it changed the entire business model. So, despite complicating political factors, the story of how Canada ended up with a single national exchange in 2008 is really about just one thing: technology. Just as it would disrupt the hotel, taxi, media, and many other industries, technology transformed the structure of the exchange industry. The focus of my talk today is about how technology changed the rules of the game and how industry players responded as a result. So the 1980s brought a major wave of digitization to the financial services industry. The first big impact was reduced geographic barriers between markets. At that time, most of Canada's largest issuers were listed on both the Toronto and Montreal exchanges. However, the transparent, real-time pricing brought about by digitization made it easy for buyers and sellers to migrate across markets. Trading activity began to migrate from Montreal to Toronto, and soon after, Canadian issuers, particularly the largest and most actively traded, began to list their shares in the U.S. to reach new pools of investors. While listing in the U.S. increased overall trading activity, it also meant that Canadian investors could trade Canadian securities on U.S. exchanges. Ultimately, the reduction in geographic barriers increased competition for both listings and trading volumes. Reduced geographic barriers also impacted the evolution of Canada's nascent derivatives market. During the late 90s, derivatives trading was more advanced in the U.S. When Canadian firms began to interlist on New York and NASDAQ, derivatives activity in their securities evolved south of the border as well. Once again, because liquidity begets liquidity, once this liquidity was established in the States, it became virtually impossible to repatriate it years later once Canada's derivatives capabilities evolved. As the need to continue modernizing systems grew, the fixed costs of running an exchange increased. Under the cost recovery model that governed exchanges at the time, the members had little incentive to make these capital investments because they had to be funded through higher transaction costs. This was particularly an issue in Montreal, where the migration of large cap trading volume to Toronto meant fixed costs had to be amortized across a smaller transaction base. As a result, Montreal was developing a substantial technical debt that represented a growing risk to the stability of the market. What stakeholders didn't see at the time was that the increased price transparency, transaction speed, and geographic mobility that technology enabled would also lead to explosive growth in trading volumes. Technology birthed two entirely new types of investing that were key drivers of this volume increase: derivatives and high-frequency trading. These were different because while traditional strategies were about buying a share of a company's future earnings, these strategies were about making side bets of a sort and exploiting pricing inefficiencies that existed around that fundamental investing activity. Complex computerized pricing algorithms were the foundation of both these new types of trading. As computing power increased and more traders competed to profit from these inefficiencies, they became smaller and more fleeting. Over time, traders moved in and out of positions faster and faster, thus generating more and more trade volume. Low transaction fees were key to these strategies because the market opportunities they exploited were very small, and traders needed to do many, many transactions to generate a material profit. Over time, derivatives and high-frequency trading grew to represent a large proportion of total liquidity. And again, because liquidity begets liquidity, it was critical for exchanges to offer competitive fees to attract these investors. Exchanges even started paying investors to do this type of trading on their venues. And so it was that technology led to a dramatic reduction in transaction fees. Because technology automated so much of trade processing, as fixed costs increased, variable costs declined. And since price is ultimately set by marginal cost in competitive markets, this shift from a variable to a fixed cost base initiated a race to the bottom for transaction fees. So to recap, Technology reduced geographic barriers, increased fixed cost, increased volumes, and reduced transaction fees. The upshot of all this was the creation of an entirely new revenue stream, selling data and analytics about the trading that occurred on the exchange. This essentially is shifted the exchange business model from one that created value from processing transactions to one that competed to process transactions to gather data it could sell to support the development of new trading strategies. Like a growing number of firms whose legacy business has been about processing transactions, exchanges are primarily in the transaction business today because it enables their data business. So now let's put these drivers into a historical context. Back in the 1990s, the long-term impact technology would have on the exchange business model wasn't clear to most of the industry. At that time, there were 5 exchanges in Canada, each trading a fragmented mix of security types. They were member-owned and much more focused on minimizing trading costs than innovating. While there was general opposition to funding the capital improvements needed at all 5 exchanges, the industry knew something needed to be done about its growing technology deficit. Montreal's systems were a particular concern. Montreal had been the derivatives leader in Canada, listing the country's first options in 1976 and its first futures in 1982. However, the growth and increasing complexity of the derivatives market and of derivatives trading necessitated continued technology enhancements. Policymakers were also concerned because interest rate derivatives played a strategic role in setting prices used by the Bank of Canada to implement interest rate policies. Failing to support the development of key interest rate products simply wasn't an option. However, the size of Montreal's derivatives business didn't justify these investments, and with the large cap equities trade increasingly flowing to Toronto, there wasn't a robust enough revenue stream to subsidize it. By the late 1990s, the situation was getting pretty dire. So in 1999, the industry came up with a solution called the Realignment Agreement, and it redrew the exchange landscape in Canada. The specific terms of the agreement were as follows. Vancouver, Calgary, and Winnipeg would be consolidated into a single venture exchange based in Vancouver. Senior equities trading would be consolidated in Toronto, and derivatives would be centralized in Montreal. There was something in it for all parties, at least in the short term. Venture activity got critical mass by being consolidated in Vancouver. Toronto got a boost to its large cap equity trading business, and which increased efficiency by leveraging its existing infrastructure. And Montreal received an equalization payment for giving up its large cap equities business, which gave it the cash it needed to fund the system improvements that were required. It quickly migrated all derivatives trading to an electronic platform and closed its physical trading floor in 2001. The crisis was averted, but it was clear to industry insiders that a new ownership and governance model was needed to ensure the industry's long-term sustainability. Through the latter half of the 90s, exchanges around the world had begun to demutualize. TSX followed suit in April 2000, as did Montreal later that year. TSX went on to publicly list its shares in 2002. Some industry participants worried that TSX, as a for-profit corporation and having a monopoly on the large cap equities market, would drive fees up. However, the continued march of technological progress blunted TSX's market power pretty quickly. NASDAQ opened a Montreal office in 2000 and quickly captured 142 listings. Then, in 2001, regulators approved the introduction of alternative trading systems. into the Canadian market. While neither competitor really amounted to much, their very presence made it clear that the threat of competition couldn't be ignored and that the exchange industry was only at the beginning of a period of rapid change. In the wake of the privatizations that had occurred during the late 90s, the new millennium brought a wave of consolidation activity. Amsterdam, Brussels, and Paris merged to form an exchange called Euronext. Euronext then acquired the London Futures and Options Exchange, and TSX acquired the Canadian Venture Exchange. This merger activity had two key implications. First, exchanges around the world were building scale to attract traders and issuers to their venues. And second, equity exchanges were starting to merge with derivatives exchanges. Derivatives were becoming an increasingly important asset class, and trading between derivatives and their underlying securities became more prevalent. The increasing speed at which much of this trade occurred was making it important for both types of securities to be traded on the same exchange. Back in '99, it hadn't looked like TSX being cut out of the derivatives market would be a problem. However, just a few short years later, that was no longer the case. Meanwhile, Montreal had continued to progress in the derivatives space. It followed the 2001 conversion to electronic trading with the launch of a next-generation system in 2004 called SOLA. That system would go on to be licensed to several exchanges around the world. Meanwhile, Montreal's volumes and profits also grew. However, while Montreal's profits were strong, the overall derivatives market in Canada remained underdeveloped. Most of Montreal's revenue was driven by two key products: interest rate futures on 90-day bankers' acceptances and 10-year Canadas. Areas that would have seemed a natural fit for Montreal, like energy futures and options on large-cap Canadian equities, had already been claimed by U.S. exchanges years earlier. Through the first part of the 2000s, it looked like TSX was moving from strength to strength. While unit trading fees had declined, profits still grew because markets were strong and volume was robust. However, by the middle of the decade, its long-term growth prospects were in doubt. With trading fees continuing to decline and more issuers listing on foreign exchanges, two of its three lines of business were under threat. Its inability to play in the derivatives market further impaired its competitive position. In 2006, there were three obvious paths to explore: entering the U.S. market, building a derivatives business in Canada, and acquiring Montreal. An opportunity had emerged to enter the U.S. market when the MX exchange was put on the block. While the U.S. market was vast, it was also extremely competitive. Merging TSX with a regional American exchange really wouldn't do much to increase the scale or competitiveness of either entity, so this option was rejected. As for building a derivatives business in Canada, the realignment agreement had contained a provision that barred Toronto from entering the derivatives market for a period of 10 years. With the expiry of this agreement fast approaching, TSX could begin working to establish derivatives capabilities so it was ready to hit the ground running in 2009. This option would allow it to start with a clean slate, unencumbered by legacy systems or political constraints. Of course, competing with Montreal would likely lead to costly talent and price wars. The other option, of course, was to buy the Montreal exchange. While a greenfield entry into the derivatives market would be costly, a takeover was certain to be expensive in other ways. The high growth rate of the derivatives market meant Montreal would likely command a hefty purchase price. It was also politically perilous and could leave the combined organization with significant constraints around its future activities. After a 5-year lull, exchange merger activity in other countries returned with a vengeance in 2006. It brought more consolidation of equity and derivatives markets and the first transnational mergers. In the end, a merger between Toronto and Montreal made too much sense to ignore. As a fallback measure, or perhaps as a negotiating tactic, TSX announced in March 2007 that it would launch its own derivatives exchange. Formal merger discussions were initiated in May, and a deal was announced in December. As TSX management had expected, the price was high and the constraints were significant. Key among them was the provision that derivatives trading operations would have to remain in Montreal. The Competition Bureau approved the deal on the basis that technological advancement, and globalization had introduced sufficient competitive alternatives. This was borne out 3 short years later when management would agree to sell what became known as TMX Group to the London Stock Exchange. I started writing about the merger of Toronto and Montreal back in 2011 when a consortium known as the Maple Group launched a competing bid for TMX. It seemed important for people to remember the story of how TMX was created as they were laying the foundation for the next chapter of the industry's evolution. The key learnings from this history, as I see it, are as follows. Number 1, network effects are extremely powerful. Whether it's bringing together buyers and sellers of securities, owners renting assets like cars or condos, or people sharing information on a social network, it's extremely difficult to move activity from one marketplace to another. So while it's very difficult to move the same type of activity from one place to another, new types of liquidity, however, can change the game. While derivatives and HFT didn't seem relevant to the TSX back in '99, as they grew, they became linked with traditional trading in ways people hadn't anticipated. As a result, insurgents that specialized in these computerized trading strategies became a real threat. And finally, innovation often brings unintended consequences. So it's broadly understood that technology advancements generally increase fixed costs and reduce variable costs. However, what's often overlooked is the likelihood that this shift will cause people to value different things. In the case of stock exchanges, technology created entirely new approaches to investing that required new capabilities and transformed the industry's pricing model. I believe these takeaways contain important lessons for the financial services industry today. Technology has enabled a plethora of FinTech startups to offer customers more convenient ways to fulfill a variety of financial tasks. Individually, these insurgents represent a relatively minor threat to incumbents. People have entrenched behaviors with their existing providers, and they have limited tolerance for fragmenting their financial needs across many sources. That doesn't mean, however, that this new way of doing business isn't a substantial threat in the hands of a different type of competitor. For example, I believe that Amazon, with its vast analytical capabilities and growing reach into consumers' lives, represents a very real threat. Technology reshaped the exchange industry in a way that made the 2000 merger of Toronto and Montreal largely inevitable.
Largely which?
Inevitable. With the benefit of hindsight, the forces that were unleashed by technology were fully in motion in 1999. The realignment agreement that redrew the exchange landscape that year certainly met the short-term needs of industry stakeholders. However, in the long run, it probably impaired the development of the derivatives market in Canada, and certainly ended up costing the industry more than if the need for the merger had been acknowledged years earlier. Of course, technology continues to disrupt. In the 2000s, it was faster communications and trading systems. Today, it's distributed ledgers and machine learning. This history contains valuable lessons for executives and policymakers as they chart the industry's course forward. Thank you.